Welcome to Financially Speaking. I'm Sean Latter. Now, for many South Africans, capital gains tax, or CGT, has managed to stay well below the financial radar. However, since its introduction in October of 2001, this tax has continued to gain steady momentum and is fast becoming an important factor in financial decision-making. Joining me in studio to discuss capital gains tax and what it may mean for your financial well-being is Raylan Dunbar, financial advisor at FinLogic, Discovery's head of legal services, Harry Joffe, and Cheryl Howard of Cheryl Howard and Associates. Firstly, to the guests, good evening, welcome to the show. I'm looking forward to the discussion. Before we jump into that, though, is a quick look at a viewer's question that we received. It comes from Alan in Cape Town, and he asks, I have a large house which I rent out, and I live in a small townhouse which I also own. Please explain how I can utilize my 1.5 million rand exemption. Cheryl, I'm going to throw the question straight at you very briefly. I think if you could give a broad overview, what is capital gains tax, when is it payable, and how does it apply to someone like Alan in that circumstance?
All right. Sean, capital gains tax is literally a tax on profits that every South African resident, be it individual, a trust or a company, is liable to pay, and it's essentially on the profit between what you acquired the asset at and what you sold the asset at. With regards to Alan's question, residential properties are obviously exempt from capital gains tax to the extent of 1.5 million rand. An individual can only have one primary resident or living one primary residence at a time, and to that extent his problem where he's renting out a large home and living in a small townhouse, the small townhouse will be deemed to be his primary residence, and obviously when he sells that property will be subject to the 1.5 million exemption. If he sells the property for less than 2 million rand, there's been recent changes in the legislation that any property sold for less than 2 million rand is automatically exempt from capital gains tax. If the purchase or the selling price rather is higher than the 2 million, obviously the 1.5 million will be subject or will be exempt, and the balance subject to capital gains tax. So unfortunately in Alan's case, his small property will get the exemption and he will have to pay capital gains tax when he ultimately sells the larger property.
There's an exemption to that rule as well. If a person has a primary residence, they live in it for a year. 5 years he then moves, say, into his smaller property and then moves back to his original property for another year before he actually sells that property. It would actually be deemed to still be his primary residence, and that way he could actually claim the full 1.5 million rand exemption off of the main property and not off his smaller property.
For what I call as well, that exemption goes on to list a whole lot of requirements for that, some of which is you have to live further than 250 kilometers away from the other property.
I mean, that's why he's not living in that big property. He's using it as a business property in a sense, so it's not seen as a residential property. So that would knock him out.
Okay, so a number of exemptions. General rule of thumb is basically you're going to get the exemption on the property that you live in. Just quickly, I mean, Harry, from your side, when you're looking at capital gains tax, we know that it's relatively simple to say, well, the proceeds is what I've got to work with. I'm then minusing or deducting the base cost, okay, which is, in other words, the cost of acquiring that.
What you paid for it or what. You see, a lot of our clients have trouble when they start a business and they actually haven't paid anything for that business. They started off with nothing, or it's intellectual capital. And then you've actually got very little, if any, base cost because you haven't paid anything for it. And it can become very punitive, CGT on that side. You know, you run a business for 20 years, you started it for nothing, and then when you eventually sell it, then you could pay CGT almost on the full proceeds that you received for it.
And I guess, and this is really the question that comes in as well, is it started in October of 2001. We're hitting on 9 years. As time goes by and as people's capital amounts actually increase, so this tax that's sort of lying under the radar, no one knows about it as yet until that time of disposal comes about, and then suddenly they might be in for a bit of a nasty...
You see, another point, of course, is CGT is a death tax as well. So even if you don't sell your asset when you're alive and you hang on to it, you know, frantically, when you die, they still get you, just like estate duty. So you can't avoid CGT forever.
Yeah, it's the question of disposal. What is it that is deemed as disposal?
Right, being a deemed disposal, correct.
Absolutely, absolutely. Let's talk death quickly on your side, Raylan. I mean, there's a lot of talk that's been abound in terms of estate duty and is it going to stick around, and many commentators looking at it and saying perhaps CGT is the mechanism they're going to start using to levy that estate duty, just in a different form.
Yeah, capital gains tax was really brought out really as the catch-all benefit in terms of tax. So anything that you haven't already paid income tax on, you effectively could pay capital gains tax on. So it's really just that tax that sort of is that catch-all benefit. We're finding even at the moment in smaller states that are under the 3.5 million rand abatements, they still have quite large capital gains tax implications. And with that, the liquidity in their state is not always correctly structured. And for that reason, life policies and that type of thing need to be set up to the trust, to the actual estate, so that a person would then be in a position that they've got the liquidity in their estates so that they can actually pay off those capital gains taxes or offset the losses at the year of death. Because during the year of death, you get 120,000 rand exempt in terms of any capital gains tax as such in that year. And all of your assets are deemed at market value effectively the day before you die. Yes. So those are the values that are actually used.
You see, Sean, a CGT is actually much harsher than estate duty if you think about it. Because estate duty, you've got a 3.5 million rand rebate or 7 million per couple. But at CGT, you've got 120,000 rand, which is a tiny rebate, almost negligible. So if you take 7 million for estate duty, the average South African doesn't have an estate duty problem. You know, it takes 95% of people out of that net. But CGT, as Rayland is saying, most people have got a CGT problem.
Unless, of course, then bequeathing to the spouse.
Correct. Well, in fact, that's what I was going to say, is bequeathing to the spouse, because then you have the rollover relief. Sure. But also from it...
Sorry, it's the last time you ever roll over your spouse. That's a joke I've got to make. It's for CGT purposes.
The other important one is who actually sells the, in the event of death, which taxpayer actually sells the asset. Because there could almost be three taxpayers in the form that you have the taxpayer, and as Harry's quite correctly said, as at the date of death or the market value of the assets the day before the death it's a deemed disposal, with, as Raylene said, the 120,000 exemption. Then the assets get transferred into the deceased estate. If those assets are liquidated in the estate, there's another capital gains tax event. Or those assets could then be bequeathed to a beneficiary. The beneficiary then, when he or she sells the assets, there's a capital gains tax event. So it's very important from a planning point of view to make sure that your asset is either sold or distributed to your surviving spouse, or you clear on the fact that you want your estate to sell the trust, or you're going to bequeath the assets to your beneficiaries, and they then would onward sell the assets and have that capital gains tax benefit in their hands.
I think, Sean, we do a lot of winding up of estates. Carrying on what Cheryl's saying, it's very important that your executor's got the choices here. Because, you know, it can take 4 years to wind up an estate. So, you know, the shares could be trading at one value 4 years ago when you die, a totally separate value 4 years later, and your executor's got this nice flexibility now to play around with values. Does he sell the shares? Does he hold them? Does he pass them on? All of which got different CGT consequences. So it's a very valid point that. This allows flexibility in your will and in your executor appointment and the planning what they can do.
And while we're on from a will point of view, another one that's quite important that a lot of people fall foul of is that if there's any loan accounts owing to the deceased, be very careful not to bequeath those loan accounts back to the individual. Especially, for instance, parents who lend their children funds to acquire properties, and the other one is individuals who literally have trusts. And as soon as you bequeath that loan account back in terms of your will to the beneficiary, there's a capital gains tax event for that beneficiary. So again, the structuring of your will is very important.
Very important, and it's seeming more and more the capital gains tax is touching on more and more elements of one's personal financial life.
Well, that's the point of CGT, to stop you manipulating, to stop you trading, to stop you moving assets around. That's really the point. Trevor Manuel called it the wicket keeper of taxes when he brought it in, and that's exactly what it is. All the stuff that falls through the cracks, CGT catches.
And you often find as well that when people have taken advantage in terms of estate duty or taken advantage in terms of income tax, the capital gains tax side will be higher, so it actually catches them out in that event. So the idea is make sure whatever you're actually disclosing is correct, because you'll very often find that if you try and squeeze a value around or change a base cost around for one event, you're in a position where it actually can start changing the whole value of estate duty and various income taxes, etc. as well.
So on and so forth. Absolutely. Okay, so what we know is basically it's levied on, as you said, the profits or the gains made on any asset that you own. Of course, that doesn't apply to all the assets. Harry, what are some of the assets that we actually exclude and take off the list for the purpose of CGT?
Well, the main one, of course, coming from Discovery is insurance policies. So as long as you've got an insurance policy which is not ceded, in other words, the first owner is still the owner, then the proceeds of that insurance policy are free of CGT when they pay out. Obviously, there'll be a tax potentially in the insurance portfolio, but the actual proceeds are free of CGT, number one. Number two, all your personal use assets, so your clothes, your furniture, your nice ring, your watches, things like that, are all free of CGT. Even more interesting are things like paintings, artwork. All of that, a personal use asset free of CGT as long as it's owned in your own hands. So if you have a painting in a trust, it would not be free of CGT. And that's quite an important warning for a lot of our clients. So personal use assets generally, including your cars, your Porsches, your Maseratis, as long as, again, owned in your own hands. Then there'll be no CGT there. What's not free of CGT in that are things like property, shares are very particularly mentioned to not be free of CGT.
Yes.
Personal rights over property such as usufructs and things like that. And then, although jewellery is free of CGT, gold and platinum coins are not. So people owning Kruger Rands and that are not free of CGT.
Yeah, okay. Cheryl, let's talk numbers now. We know that we're potentially going to get taxed at some stage in our lives, and it is going to be called capital gains tax. How is it that we go about actually calculating how much we're liable for?
Okay, the capital gains tax is included as part of the normal income tax calculation. But there's a process on the basis that you would take the base cost minus the proceeds, and that profit minus an exclusion figure, an annual exclusion, and it's 17,500 rand per individual per tax year. That's deducted. Then if you're an individual or a special trust, 25% of that figure is then included in your income tax and added to your normal salary calculation and taxed at your average tax rate. Or marginal rate. If you're an individual, as I said, it's the 25%. Companies and trusts don't have the 17,500 rand annual exclusion, and 50% of the gain is then included in their taxable income. So for an individual, you're looking at an average tax rate of anything between 0 and up to 10%, being 25% of the highest tax rate of 40%. Trust or taxed capital gain is essentially 20%, being 50% of 40%, and companies are essentially 14.5%. Or 13.5% being 28%, 14% being 28% of, or 50%
of the actual 28%.
What's important though is if you've made a capital loss, that capital loss can be offset against other taxable income. My apologies. Capital gains can, the capital losses can't be set off against other taxable income. Your capital loss is then carried forward. But if you've got a trade loss, that trade loss can be offset against capital gain.
Okay.
So losses carry forward. In your first year, you lose the 17.5% exclusion, and thereafter is carry forward, and it's carried forward indefinitely on that basis.
Okay, perfect. Well, I certainly want to get to the companies and trusts just now because you can see there's a significant difference on that. But for now, we're going to take a short commercial break. When Financially Speaking returns, we continue with our in-depth discussion on capital gains tax. Don't go away.